Hello business owners, my name is James Cunningham and I want to welcome you to this webinar titled How to Use Your Family Bank. For those of you who have just tuned in, and if this is your first exposure to the Family Bank, this is actually a sequential video on how to use the Family Bank. So if you haven't had the chance to watch the first video called The Intro to the Family Bank, certainly stay tuned and we'll give you information on how you can get involved and watch that first video. But we want to start out by asking the question, why the Family Bank and why should we listen to James? Well, I've actually been in the business world for about 18 years as a consultant. I actually started out my career as a stockbroker and eventually became a registered investment advisor. But quite frankly, I had a hard problem with that. I didn't like the idea of ever having to communicate with my clients that they just lost money based upon the recommendations that we made for them. So I continued my education, went on to get a life insurance producer's license, and this opened up an entirely new world for me. It allowed me to see that you didn't have to put your money at risk at all, but you could still get the same rate of return. And only life insurance products that had investment grade components to it allowed us to do that. And eventually I went on to get my bachelor's degree in accounting and got my master's degree in taxation. And the reason that I felt that that was important was because normally when an individual is looking at a financial advisor, there are different realms of advising. For example, if you went to just an accountant, he would look at how things are going to look on your tax return. If you looked at a stockbroker, he's only going to look at the component of what's the best rate of return for your risk level. But then there's also the life insurance guy who's going to go straight away from risk and trying to protect you. But without having all three areas of financial advising, I felt that most people, when they would get a plan, there were major holes left in that. And so I wanted to be able to bring together the three central components of financial advising together. And that's why I went on to get some of my additional licenses. And I actually wrote a book about it called 6 Steps to Permanent Personal and Professional Financial Independence. And we're going to show you how you can get a free e-version of that, but you're more than welcome to go to Barnes & Noble, Amazon.com, or even our website, Cunningham Financial, to get your copy of the book. But I do want you to know that for about the last 7 to 8 years, I have been focusing very specifically on the small business owners. The vast majority of our clients are doctors, individuals who have high net worth income coming in, but also individuals who are very poor at running their own businesses. An average dentist, an average chiropractor, an average medical doctor will spend anywhere from about 4,000 hours in their particular medicine, and they become experts at healing their patients. But on average, there's only 3 hours of business courses. So they're good at healing us, but very, very poor at managing money and saving money, getting out of debt, and running their businesses. So we have naturally been able to work with thousands of doctors around the country. And some of the doctors, some of our clients, for example, this particular client of ours says in nearly 10 years that I have known James Cunningham, he has always thought out of the box. That is the kind of expertise I seek from a financial advisor. Another doctor said, CFG helped me with tax planning and taught me ways to keep my overhead down. Another doctor said, we were able to help save him more than $18,000 in business just from dealing with personal tax issues. So again, you can see that not only are we about saving money, but we're learning how to make more money, and more importantly, how to save that in the Family Bank. And this video here is going to show us how to leverage that money within the Family Bank. But one of my good friends here in Utah, Dr. White, said, in less than 3 years, I paid off more than $180,000 in student loans, bought half my practice, put a down payment on a plot of land where I want to build my dream home, all with the Family Bank. My good friend Dr. John Demartini, who is one of the individuals and the experts that starred in the movie The Secret, says, it has been stated for many decades that there are many roads to financial independence or freedom, and this is certainly true. Some for sure are aggressively risky and rocky, and others more conservatively smooth. Some are filled with potholes and others just newly paved. Since all such roads eventually end up under construction, you will require a guide, a mentor, or a mentor to carefully wave you through. This is what James Cunningham can now, with his most insightful book, begin to do. Dr. John Demartini, and he is a human behavioralist, an educator, and a best-selling author himself. Now, if you want a copy of the free copy of my ebook, you can go to our website, or you can also request a free DVD on the intro to the Family Bank if you haven't had a chance to watch that. So let's go ahead and begin. We've all heard what the definition of insanity is. It's doing the same thing over and over and over, expecting different results. But if you look at our financial lives and our business careers, we do this. We run in circles. If you could imagine, if you look at the typical business owner that's maybe generating $500,000 per year in his business, over a 10-year period, you have learned how to generate millions of dollars. In fact, $5 million has gone through your hands. But the question is, how much of that $5 million did you get to keep in your own account? And that's really part of the issue that we're going to be dealing with here. A lot of people, a lot of business owners know how to make money, but they don't know how to keep money and save it. And that's exactly what the Family Bank is designed to do. So some of the topics that we're going to go over is we're going to talk about what is the Family Bank. We're going to talk about the downfall of liquidation, the power of leverage, and we're going to go over some specific examples. In the real world, when most of us get up, we decide that we're going to go to work and we're going to generate money, whether you're an employee or a business person. At the end of the pay cycle, we expect a paycheck and we get all excited. After all, that's what we've been going to work for. But we very quickly learn that we've got to restock the refrigerator, we've got some bills to do with, maybe we have some student loans or pay for our kids' college education. The fact is, most Americans and most business owners are buried in debt. In addition, that excitement on payday turns into a little bit of frustration, and at the end of the pay cycle, we realize that everything that just went through our hands is now gone and we've got to start all over again. Again, if you're a business owner and you've generated millions of dollars over the course of the last 10, 20 years, and then look at how much you're able to keep, this is the common scenario that we're talking about that we need to get rid of. Oh, and by the way, we all have a silent partner called Uncle Sam, and a good portion of our income has to flow out to him, even though he never shows up to work and never helps us with our daily businesses. But in the end, he's the one that gets sometimes a bigger portion than we do. So what we want to be able to do is not worry about this. Let's understand what the Family Bank is and now learn how to take control of our cash flow. So let's talk about what is the Family Bank. Well, the Family Bank is a concept that I developed years ago when I started working with fixed equity index accounts. Remember, I started out my career as a stockbroker and I found that they were just too risky and I felt uncomfortable with making only risky investments. In fact, Wall Street doesn't care about the risk factor. They are paid to make money the old-fashioned way, which is they are paid to risk your money. And then when I got into life insurance, I found out that with the fixed equity index accounts, even if we're dealing with IRAs, 401ks, or even life insurance, you can get exactly the same rate of return without any risk. And then I came across a book. Well, it's really more of a pamphlet. It was written in the 1950s about how to leverage whole life insurance policies. And it talked about becoming your own banker. And the concept I fell in love with. And I started really researching, seeing what insurance companies were out there, what kind of investment strategies were out there. And the one advantage that I did find about whole life insurance policies is the loans that you take are 100% tax-free. But there's some problems with that. There are two major downsides when you use a whole life insurance policy. First of all, when you take a loan from the whole life policy, it literally drains the policy amount. For example, if you have $50,000 in a whole life policy and you needed to take a loan for $30,000, now you only have $20,000 left over. Life insurance policies that are whole life design were never designed completely to ever take a loan, even though you could take the loans out of it. The other problem was that even though you're draining your own account, your own money in there, the insurance companies charged a fixed rate of return, typically right around 8%. So not only are you taking out $30,000 from a $50,000 account, but now you have to pay interest on that. Well, most people realize that because that 8% is out there, that 8% would eventually eat up the other 20%, and these policies would eventually become collapsible policies. And then no more insurance. So with the policies that we've researched and the ones that we recommend, it eliminates both of these problems. First, there are insurance companies that literally allow you to collateralize the loan against the death benefit instead of taking or sucking out the cash value. So if you learn to do this correctly, obviously collateralizing versus liquidating is something that's very important and a key component to the family bank. This is a very powerful concept that makes it difficult because it seems too good to be true for most people until they understand it. The second advantage with the family bank is what is called fixed equity indexed loans. There's an interest rate that the insurance company is mandated by the IRS that they have to charge us. But at the end of the year, the insurance company has the right to credit your account back the interest rate that they charge you. So where a whole life insurance policy or a variable universal life policy or a universal life policy charges a fixed rate that stays on the books forever, here we can learn how to borrow against the death benefit, get an interest rate, but have that interest rate credited back against itself. So that at the end of the year, within the first 10 years, there may be a slight charge, but it's what I've seen over the last 4, 5, 6 years is about a 0.22%, less than a 0.5% interest rate. But once the family bank has been opened and kept alive for at least 10 years, then it becomes what is called a wash loan, that the insurance company credits you back exactly what the IRS tells them they have to charge you. Very big advantage. And there it is. If you keep it for at least 10 years or longer, then it's a wash loan. One of the other big things about the family bank is the fact that we've encompassed the idea of a complete strategic financial plan. This involves, for business owners, setting up the right type of business like an S corporation and an LLC. And it also includes setting up a personal family trust and the family will. As you can see, when you combine the components of a good, solid strategy, mentally you can picture your family bank conceptually where it is this huge vault that is wrapped around your finances to protect everything that you've worked for that is safe, secure, and is impenetrable. This is the concept of the family bank. The fixed equity index inside the family bank or the life insurance policy is the catapult or the impetus of putting everything together. So in summary here, the family bank allows us, the team at CFG Consulting, to be able to strategize the necessary components to make your business more successful, to help you also combine the component of a personal retirement strategy along with a tax strategy or a full comprehensive planning right now as your business is growing and developing and at the phase where we move into retirement. So let's talk about the downfall of liquidation. Imagine, if you will, that you have $50,000 and that money you put inside of a vault, you put it inside of a coffee can, you bury it under your pillow, you even put it down at the local bank or credit union. Anywhere where you have some cash, try to imagine that. But now let's look at some problems with liquidation strategies, and this is simple mathematics. For example, if you have $10,000 in an account and you need $5,000, when you go reach your hands into that account and pull the money out, you're only left with the remaining amount, which is $5,000 in this example. Now, when you spend that $5,000, it's gone forever and it is liquidated. But now let's look at what happens when you retire. Let's say that you have a retirement account like an IRA, a 401k that's got $500,000 on it, and you need $50,000 to live on. Well, if you take the $50,000 away from the total value, you only have $450,000 less. Now, the number one concern for individuals that are retired or people over the age of 62, reported by AARP, is the fear of running out of money. Any type of strategy where you reach your hands in and pull something out and the value is less than what you started with, that is a liquidation problem. When you pull that money out again and spend it and live on it, it is gone forever. It is just like the next year throwing the money down the drain. So what we're doing is we're losing out on what is called opportunity cost. If you were to take that $50,000 out of the account, it's no longer going to make money for you. That is your opportunity lost. But if you were able to keep the $50,000 in the account in 5 years at an 8% growth rate, that is now $59,000. 10 years, it is $74,000. 20 years later, it's now $128,000. But because you spent $50,000 today, you will never get the $128,000 20 years in the future. And this becomes a key component. If any of you have had me build you a personal plan, you know that the very first thing that I talked about is the definition of financial independence, the true definition of financial independence. And that is having a pool of money large enough to produce an income stream to pay for your wants, needs, and desires without depleting your pool of money. You see, if you have the ability to lose it because of liquidation, you do not have true financial independence. So, the family bank. Let's look at a real example. Let's say that you want to buy a car. You've got your eye on a specific vehicle that you want, and it comes with a price tag of $30,000. Now, there's a couple of different ways that you can pay for it. First of all, if you've got $30,000, in your home safe or at the bank, you can liquidate that account and pay for the car in cash. But what rate of return do you now earn on that $30,000? Like the case I just made, it is now zero. You exchanged $30,000 in cash for a new car, but the cash had the opportunity to compound in interest and grow bigger for you, but now it's gone forever. Another way you can do it is you can learn how to finance it. You can come up with a monthly payment, say $500 per month from a leasing company or a lender. But again, what rate of return are you going to earn on debt payments that go out the window? Again, the answer is zero. You can also lease the car, but problem is the same. The money you spend is gone forever. Or we can learn how to use the family bank. Now, with the family bank, what we can do is you can keep the money and get the car. So let's talk about how to do that. First of all, if you have your family bank set up and you know that you've got at least $30,000 in that account, you then can borrow the money from yourself and collateralize that against the death benefit of your insurance policy. Here would be the example. Let's say that you have $100,000 in the bank and you went to the bank and said, I want to buy a new car. And they said, great, you have the money here, but there's a special that day. The bank says, you know what, as long as you buy the car, we'll give you the cash out of our pocket, but we're going to give you a loan and you can keep your $100,000. You don't have to pay any interest rate. Maybe you have to pay 0.22%, but when you die, we're just going to pay back the $30,000, but we're not going to do it with interest. We'll just take that back the $30,000 and give your spouse the remaining $70,000. How many of you would start buying everything that you could exactly that way? Well, that's exactly what we're saying to do with the family bank. So you have the $30,000, you borrowed it from your own family bank, you collateralize that in a loan with the insurance company. The insurance company says, here's the money from our pocket, not yours, but pay us back when you die. You now take that $30,000 to the auto salesman and you tell him, I have 30 grand. He says, great, let me give you the car, and voila. Now what you're doing is you have the car of your dreams and you kept the $30,000. So let's look at a comparison. You still paid for the car in cash, but did you have to liquidate your cash value in your family bank to do it? No, you didn't. You didn't have to liquidate money from your bank account. You didn't even have to finance it. The money that you would have thrown away from financing or leasing, you now get to keep in your own pocket, or maybe save more money in the family bank. But the family bank allows you to be 100% debt-free, to get the brand new car of your choice with absolutely no payments, and you keep the full value in your family bank. Now, if you're a business owner, there's some added advantages. First of all, if the business makes the contributions to the family bank, you can learn or structure this where you can get a tax deduction on the premiums or the contributions. Now, there is a couple other advanced issues that we have to deal with that, but if you're a business owner and you have a huge tax liability each and every year, and you would rather put that money in your own pocket rather than send it off to the IRS, then we should talk. But when the loan is taken out, it is 100% tax-free. It is collateralized against the life insurance portion of the family bank, and that has to be paid back, but when? Only upon your death. That may be 10 years, 20 years, 30, 50, 60 years from now. But if you are a business owner, instead of a car, what if you need a new x-ray machine? What if you need a new piece of equipment that costs hundreds of thousands of dollars? What if you need to pay some back taxes? What if you need to develop a new marketing strategy, but it's going to cost you money that you don't necessarily have, or anything? In fact, with most of our clients, we say that if you have a cost of $5,000 or more, whether it's to buy a new car, a new motorcycle, a trip around the world, a new boat, a new x-ray machine, whatever it is, give us a call first. Let's see if we can strategically get a loan through the family bank so you can keep your money and pay that thing off and stay debt free. So watch this. This is one more component to this, and this is where we start to get into some tax planning. What if you take the loan from the bank and you need to buy an x-ray machine or something for your business? You take the loan from your family bank. The insurance company is going to send the money to you directly. You're going to take that money and you're going to deposit it into your own personal checking account. But then, using a very strong accountant like myself or an accountant of your choice, they help you create a legitimate loan agreement between you and your business. And now you're going to loan your business the $30,000. The business is then going to take the money, buy the asset in cash, but the business now owns the asset debt-free, but owes you $30,000. You now are showing up as a liability because you are a lender to your own business. Now, let's say that normally you have a salary of $100,000 per year. Now, with that $100,000, you have to pay taxes on it. But instead of taking the full $100,000 that year, we tell you to only take $70,000. That's all you have to pay taxes on, and let the business pay you back the $30,000. That $30,000 now, you don't have to pay taxes on it except for the interest that you charge the business. So effectively, you could lower your tax bracket from $100,000 down to $70,000. You walk away with the exact same amount of money in your pocket. The business gets the asset, is still 100% debt free, and you walked away. It's almost like you created a financial mitosis. You had $30,000 that you just doubled to $60,000. $30,000 of that paid off the asset, and you still get to keep $30,000. Now imagine if you did that with every asset over $5,000 that you had to pay. So if you put the puzzle together, you were able to pay for the asset in cash, keep 100% of your money in the family bank, and you lowered your taxable income by $30,000.
There is the minimum one can pay for a given amount of insurance coverage for a specific age, and the maximum one can pay. Who determines the minimum? The insurance company. At the other end of the spectrum is the maximum one can pay for a given amount of coverage, and who determines that besides you? The government. The fact that the federal government limits how much money one can put into a life insurance policy says what about it? It must be good. And it must be good in relationship to taxes. Basically, the government decided the upper limit of tax-advantaged growth they would allow, and the policyholders still have access to the cash value. Policies outside this allowable corridor are determined to be a modified endowment contract, or MEC, which simply means the government will treat the insurance contract like they do qualified plans, with all the rules, regulations, and penalties. After watching this video, you will probably know more about life insurance than most life insurance agents, should you ever have to talk with one again. At a minimum, you will probably know more than they are willing to tell you. There's almost an infinite amount of premiums that can be charged between the minimum and maximum. As mentioned earlier, the insurance companies determine the minimum. They have actuaries that calculate the least amount of premium they can charge and still make a profit. They understand opportunity cost, which means they have factored in the time value of the premium. In the 1980s, the government drew the line that determined the maximum amount of contributions allowable for a given face amount of coverage. This is when the terrible twins were born, Tamra and Defra. The government said, wait just a minute. We cannot let people put unlimited contributions in a life insurance policy as is allowed currently, because if we do, they will not do what we encourage them to do. What does the government encourage you to do besides pay taxes? They encourage putting your money in a qualified plan account and defer the taxes. Samples of these accounts include 401ks, IRAs, SEPs, and 403b plans, just to name a few. Who came up with these plans? The government. What do qualified plans do? The number one response is that they defer taxes. If that's what you said they do, you were only half correct. Let's say you wanted to borrow $10,000. You would ask 2 questions before you took the money. The first question would be, how much interest do you have to pay? The second question would be, when do you have to pay it back? If the lender responded by saying, we have enough money right now and don't need any payments from you at this time, but there will come a time when we will need the money. When we know how much we need, we will be able to determine how much interest we have to charge to get the amount we need. Would you cash that check? Absolutely not. But this is exactly what we are doing with the government in qualified accounts. They are not saying you do not owe the tax. They're saying you can pay the tax later. At what bracket? That is a good question. This is not to say that qualified plans are bad. However, it is important that you know and understand exactly what they do. Now, getting back to insurance, let's assume you could pay $500 for $500,000 of insurance coverage, or you could pay $10,000. Which would you choose? Being bargain shoppers, most of us would probably say $500. Less is best when it comes to cost, right? Let's say the $500 represents the lowest premium one can pay for $500,000 of coverage at a given age. The lowest premium is known as term insurance. It provides one benefit, death benefit. Term insurance offers protection for the least expensive initial cost. The best day financially to own term insurance is which day? If you guessed the day you die, you weren't even close. The best day financially to own a term life insurance policy is the first day. That's right, it is the first day you buy it. Had you purchased the policy today, received approval, signed the delivery receipt, paid the first premium, and died on the way home from your agent's office, you cannot get better than that financially. To calculate the rate of return on such an event would be next to impossible. Granted, it would be hard to get people to sign up for this type of financial windfall, but you understand the point. If the best day to own a term policy is the first day, it means that every day you own it, it becomes worth less and less, costing you more and more. How do you feel about owning things like this? When determining the cost of term insurance, one must also factor in the opportunity cost of owning this product. Remember, the cost is not just the amount you paid in premiums, but what those dollars would have earned had you not bought the coverage and taken the risk yourself, which we are not suggesting you do. Penn State University completed a study in 1993 on term insurance policies where they discovered that more than 90% of all term policies are terminated or converted, 45% within the first year, and 72% within the first 3 years. Less than 1 policy in 10 survives the period for which it is written. After 15 to 20 years of exposure, less than 1% of all term policies are still in force, and only 1% of all term insurance resulted in death claims. What does this mean? It means with term insurance, you will most likely pay more than you receive. For an insurance company to talk you into putting $10,000 in a policy with a value at your death that you could get for $500, they would have to come up with some serious benefits. Agreed? Let's forget about insurance for just a minute and talk about benefits. In any vehicle one would use to accumulate money over time, a major desire would be to maximize benefits in addition to achieving an acceptable rate of return. If you could wave a magic wand, what benefits would you desire? Would you like the money in the account to grow tax-deferred as opposed to taxable? Would you want the money to come out tax-free? Would you want a competitive rate of return? Would you like the interest guaranteed? In the event you get sued, would you want it protected from judgments? Would you like to contribute as much in the account as you desire without restrictions? Would you like to invest in anything you choose? Would you like to be able to use this money as collateral? If possible, would you want this money exempt from estate tax? Would you want access to this money while you are working, as well as during your retirement? In the event of your disability, would you want your contributions to the account to continue even though you can no longer make them yourself? Would you want your contribution to this account to be tax deductible? Of course, you would want all these benefits if you could get them. Which of these benefits do you get from a qualified plan? There is only one product that offers the majority of the benefits on the list, and it is permanent life insurance. However, not just any type of contract will do. Life insurance policies that are minimally funded only provide minimum levels of benefits. Remember, the government drew the line that determined the maximum amount of contributions allowable for a given face amount of coverage. Contributions over this line create a modified endowment contract, or MEC. However, contributions made right up to this line create a different type of MEC that we call the maximum efficient contract. Permanent life insurance contracts offer all the benefits listed earlier, except that the contributions to a life insurance contract outside of a qualified plan are not deductible. You may be surprised to learn that there is little to no difference between deductible and non-deductible contributions. In fact, tax-deductible contributions that grow tax-deferred and come out taxable are exactly the same as after-tax contributions that grow tax-deferred and come out tax-free, assuming the same tax bracket and investment interest rate. What you need to understand is that as you move from the highest possible premium to the lowest, the value of the benefits decrease. The higher the premium, the higher the level of each benefit received until you reach the MEC line. Up to that line, but not over, is the position that provides the greatest amount of benefits a life insurance contract has to offer, while still allowing liquidity, use, and control of the money. There are circumstances where one only needs death protection, and a low-level premium is desirable. In this situation, and when coverage is needed for a short period of time, term coverage may be the best immediate temporary solution. If, however, you're looking for a place to accumulate money that provides the highest level of benefits mentioned at their maximum level, permanent life insurance is a great choice. Currently, we know of no other financial product that offers these same benefits at the same level. Insurance companies limit the amount of death protection one can purchase, known as the face amount, based on present age, mortality costs, current assets, and income. The government set the MEC guidelines to limit the amount of contributions allowable in the form of premium payments that still give the policyholder access to the cash value on a tax-favored basis. How much insurance should you have? Most of us assume this is a needs decision. This should really be a wants decision, not a needs decision. There is no one wise enough to determine what one needs, since the very thought of need represents the least amount. To determine the least amount would be to assume that if one has this amount, they would be fine. It would be hard to find anyone who has been successful at anything who started off doing the least they have to do to make it. Life insurance should be considered a want product. You decide what you want to happen. Then it can be determined how much coverage it will take to accomplish what you want. Life insurance will provide the immediate funds to guarantee that what you want to happen will happen in the event of your death. Make sure your policy will ensure that what you want to happen will happen.
So now that we've watched the video, here's the summary. First of all, we want to use a fixed equity index life insurance policy because this is our recommendation. This is a universal investment grade index policy that is linked to a major index like the Dow Jones, the S&P 500, gold, or even if we want a fixed guaranteed rate of return of 5.25%. We also learned that the cost of the policy is based upon the face amount of the insurance, our age, and the underwriting requirements by the insurance company. There is a minimum premium that is set by the insurance company to cover that cost. But based on the face amount, and because these accounts are 100% tax-free, the value that grows in them, the IRS has determined the maximum that you can put into these policies without making it a taxable account or creating what is called a modified endowment contract. We also learned that there's a huge range of contributions that you can put in the policy. There's the minimum that the insurance company requires to cover the cost, but there's also the maximum limit that the IRS says you can go up to this. But at the same time, we also learned that the more you get closer to that maximum line, the more benefits that are coming out of the policy. Now, I'd like to give you an example of the difference between liquidation strategies and a borrowing strategy. What I'd like to do here is actually just show you through an Excel spreadsheet the power of leverage. And especially if you look at this example with $500,000. Let's say that it's going to earn an 8% rate of return. The individual is 65 years old, and they are going to start out with $500,000, and it's going to grow and compound. Now, over a 20-year period, if it earned 8% per year, it would grow to be worth $2.4 million. This is assuming absolutely no withdrawals. But now if you're going to withdraw, let's say this individual wants to take out $300,000 in order to pay off the rest of their mortgage, for example. Now what I want you to do is I want you to see when you liquidate the account, what ends up happening here in year 20. All of a sudden now, we know that our balance drops to $200,000, and the value of our account 20 years later is not even $1 million. So the $300,000 liquidated today in $50,000, but again, look, that $150,000 had a cost to it of more than $700,000. Let's say, just say it's something small. Let's say that's just $30,000, the car that we've been talking about. Now this car, this $30,000 in 20 years has cost more than $147,000 in lost opportunity cost. And in fact, this $30,000 car, you could have bought 2 or 3 or even 4 other cars during that length of time period. So anytime that you have a liquidation strategy where you have to pull money out and that money is gone forever, you lose the opportunity for that money to grow and compound. You can see the huge difference between leveraging an account and liquidating an account. The number one fear, as I've talked about many times, is outliving your money. So here's an example. Let's say we take Dr. Smith, who's age 45 years old. He can save $50,000 from his business. Now, out of that $50,000, the reminder is we always want to max fund the policy. We want to buy the smallest amount of insurance that allows Dr. Smith to save $50,000 a year into this. The maximum limit again is determined by the IRS, and so let's say that this particular policy has a cost of $3,000 per year. What if Dr. Smith only puts in $4,000 into the policy? See the problem there? The more you put into the policy, up to the maximum limit in the first 7 years is the ideal way to max fund the Family Bank policy. Now remember this formula from the first DVD presentation called The Intro to the Family Bank. You learned the formula 1 + 2 = 3 - 4. The cash value is our column 1. The face amount is a fixed face amount that never goes up or down, but the death benefit is the combination of the cash value plus the face amount. Then the -4 is when we take a loan. So if we have $100,000 cash value and we have a $2 million face amount, our death benefit is 1 + 2 = 3, or in this example, $2,100,000. But then let's say that we need to take $30,000 out to buy that car. This is how we do it. The loan comes out of the insurance company's pocket, not our own. It is collateralized against the death benefit. So if we do pass away, the loan is automatically taken from the death benefit. But you see here that the $100,000 in cash value remained 100% intact. And the power of leverage is everything when it comes to being able to be financially secure. So let's look at an example. Let's say that we've got a business owner who is 50 years old, and he wants to save $50,000 per year, and he wants to retire at age 65 and retire in a 100% tax-free strategy that does not penalize his Social Security benefits. So here's the illustration. We put in $50,000 per year, And all of a sudden now, here is our account value. This is the 1. So 1 plus 2, and then we have 888,000. That's the smallest amount of insurance that we have to get, or we have to buy to put in $50,000. 1 plus 2 equals 3. So that is our net death benefit. So if you go along here, the account value plus the fixed face amount equals the death benefit. So let's look at the same example, but now we have this doctor who all of a sudden has expenses he's got to deal with. Let's say that in the second year he's got $15,000 that he needs to buy a new piece of equipment. In year 6, he needs that new car we've been talking about. In year 7, he decides that he wants to take his family for 30 days on a cruise around the world, and it's going to cost a pretty penny, 30 grand. In year 12, well, you know, the car's, maybe the car needs to be upgraded, or he needs to buy another new car, but it's going to be more expensive this time. Let's say it's $60,000. In year 13, let's say he needs $15,000 to fix the roof on the house. In year 18, he still wants to retire, still needs money to live on, 100% tax-free, and he decides he needs $100,000 per year. So now we have that formula, 1 account value plus 2 equals 3 minus 4. Now we can see here that that $15,000 to buy the new equipment, the account value did not decrease at all. If I go back here, I want you to see the other one. See, it's $87,191 when you take out no loan. But now if we take out the loan for $15,000, it is still the same account value. In year 6, we take out $30,000. And you see here, now the account value is still growing, even though we're taking out loans, because the loan is a true loan from the insurance company's pocket. Unlike variable life, unlike your 401k, unlike your bank account, or if you have cash value in there and you need money and you take out the loan, it is being liquidated, but not in the type of strategies that we recommend. Now, there's a lot of mistakes that I see. A lot of people see this and they go talk to their insurance guy and they say, you know, I want a cash value life insurance policy. But if you don't choose the right company, you don't choose the right product, and you don't choose the right strategy, you could end up buying a product where you're going to liquidate your account eventually. So don't make the mistake of doing that on your own without talking to somebody who can give you the right advice. But then you see here that after 15 years, this particular business owner wanted to retire on $50,000 or on $100,000 per year. So we are going to stop all contributions whatsoever, and we are going to now take out $100,000 tax-free dollars per year. But look, when this business owner is 70 years old, he has contributed a total of $750,000. He's taken out $650,000 in the form of loans, but the value of his account that's earning and growing for him is $1.6 million. Now, if you go here, well, say when he's age 80, you know, he's going to pull out another $1 million, $100,000 per year for another 10 years. He's going to put out another $1 million, and the value of that account is now $3,463,000. This is the power of leverage, the ability to borrow against an insurance death benefit without liquidating any account. There's one more factor here. I haven't mentioned a lot about this $100,000 yet when Social Security comes into play. When you take a loan, you don't have to claim that on your taxes. It is not part of any type of provisional income whatsoever. If this $100,000 was coming out of an IRA, not only dealing with the problems of liquidation, but now you would have to pay taxes on that. But if you're filing a married filing joint tax return, and if that total amount, including your Social Security benefits, any money from your retirement plans, any pensions, any 401ks, is greater than $44,000 per in that year, now 85% of your Social Security benefits are going to be penalized, and they're going to be penalized at the tune of whatever tax bracket, your highest tax bracket that you happen to fall in that year. This completely eliminates 100% of that. And again, there's our formula. 1, account value. 2 is the face amount. 3 is the death benefit minus the loans. Now this column here, this surrender value, this is the amount of money that you can borrow in any given year as it includes any previous loans. So even when this individual is 70 years old, has taken out $650,000, he still has access to borrow $812,000. He can take it all out if he wants to. Now, you would say, well, we don't want to borrow everything. Well, look, between age 70 and 71, if he borrowed everything out that year, the account still grew over $120,000. So the very next year, he can still take out $120,000, even though he's taken out that $812,000. Now that's even more money than the $100,000 out there. So again, this is the power of leverage. So let's look at some other example. Let's take a business owner, a little bit older, 55 years old, has no money saved for retirement, and is realizing that the end of the road is pretty quick, and he's got a business that's doing a lot of money. Let's say his business is generating $1.2 million. Now, what makes him sick about this is he's been making $1.2 million gross in his business. That's over $12 million that's been flowing through his hands out the door, and he's saved nothing. But let's add insult to injury. He wants to retire in just a few years. He wants to retire at age 62. So what we do is we have him fill out the financial profile, and we find that very comfortably through the strategy of having the business cash flow come in, we can save $300,000 per year. And he wants to retire on $250,000 tax-free dollars per year when he does retire at age 62. So here we go. Okay, so here's the illustration for this doctor or this business owner who's saving $300,000 per year, and he's going to do this only for 7 years because he wants to retire. And we see our formula: 1 plus 2 equals 3. Now, what I want you to notice here is that this particular doctor is a little bit older. We're putting in more money, so we had to buy a bigger insurance policy. So the ideal situation would be to actually, if he could, put the entire $1.2 million from his business gross revenue or gross collections into the family bank. But you see, with $300,000, we have to buy nearly $4.5 million worth of insurance. We may be on the verge right here where the insurance company is saying this is the limit. We're not going to insure this person anymore. So based upon the insurance requirements also is a limitation of how much we can put in there, because we can't do what is called insure an unsurable risk, which means that simply you can't buy so much insurance. If we could, put in $1.2 million, we may have to buy a $25 million policy. But nonetheless, we're able to at least get $300,000, and we want to make sure that we're hitting this particular business owner's goal of $250,000 per year for the rest of his life. So we've got 1 plus 2 equals 3, and then of course the minus 4. Now at age 63, we're going to stop all contributions whatsoever, and we're going to start to take loans for $250,000 for the rest of his life. And you can see here again, we are collateralizing against the death benefit. And you see the death benefit going down a little bit here? That's because it's a true collateralized loan rather than a liquidation strategy. And our cash value continues to increase. Now, let's look at this for an amazing and incredible rate of return. When this business owner is 75 years old, and we look at the big picture, he's put in a total of $2.1 million into the account. He's taken out $3.2 million in form of loans, but the value of his account is still compounding and growing to the tune of more than $5 million. Now, if you tried to imagine doing this with your 401k, a profit-sharing plan, an IRA, a SEP IRA, a municipal bond, tax-free accounts, it's impossible to be able to do this. It's only possible to do it inside of the correct fixed equity index life insurance policy called the Family Bank. Now, another thing I want to draw your attention to is you see the surrender value. The surrender value is the amount of money you can take out in the form of a loan in any given year minus what you've already taken out. So at this point, when he's 75 years old, let's say that he wanted to, pay off one of his kids' dream homes for $800,000. He still has access to $828,000. Now at this point here, it goes down, so we can see when he's 80 years old, this is probably going to be, in addition to the $3.5 million he's already taken out, he could still take out another $800,000. But then you see that it starts to go back up. And that is because look at the growth. I mean, from the time he's 80 to 85, his account went from $7.5 million to $10.9 million in that 5-year period. Because when your account is never being liquidated, the only thing that it can do is continue to grow and compound over time. Now, let's look at the same example, but with a twist. We have a 55-year-old male, still has no money for retirement. His business is still doing $1.2 million. He also wants to retire at 62. But this time, he filled out the financial profile. We found out that he's able to save $300,000, but only if he has access to borrow money to help pay for his business overhead. Maybe his business isn't very profitable, or the profit margin is lower. So what we're going to have to do is pull out $200,000 per year to help pay for and supplement business overhead expenses, or maybe his own personal lifestyle. But then again, he wants to retire at age 62, and he wants $150,000 tax-free dollars to live on. So he puts in the $300,000, and immediately he's going to have to pull out $200,000 for, let's see, 1, 2, 3, 4, 5, 6 years of his business in order to pay for overhead costs. Now, if you realize what is just happening here, the business owner really is putting money into the account, borrowing it from the insurance company, and then recontributing $300,000, but he has to pull out $200,000 again just to pay for overhead costs. But does that affect or change his account value? Absolutely not. Remember that $10.9 million he had when he was 85 years old? It's still exactly the same. So no matter how much he pulled out in the form of a loan, the account value, the cash value, stays 100% intact. And again, he still gets to retire at the same time, and he gets $150 tax-free dollars per year that doesn't penalize his Social Security benefits and doesn't drain from his retirement accounts. And again, our formula, 1 is our account value plus the face amount equals the death benefit minus our loans. And again, the surrender value column is the amount of money that you can still borrow even after all the money that you've taken out previously in the form of loans. So what we want you to do is, now that you know this information, is to act now. Our economic future is looking extremely rocky. The baby boomer generation that started to retire in 2011 will dramatically change the market and the economy. Most experts predict that a recession is going to happen, but it's going to last for at least 15 to 20 years. Taxes will continue to go up along with the national debt. In addition, it's going to cause more financial crisis and more financial challenges. Inflation is already killing the purchasing power of the US dollar. Look what gasoline has doubled to over the last 4 years. The cost of food is going up. The cost of housing is going up. The cost of gas is going up. The cost of just living is going up. So you have to act now. But most importantly, do not stay in any accounts that liquidate your retirement or your savings. Learn to use the power of leverage to enhance your financial security. And lastly, enjoy a full 100% tax-free retirement that does not penalize your hard-earned Social Security benefits. Delaying the proper use of funding your family bank can literally cost you millions, as you've just seen. If you have the family bank established, good. Use it well and max fund your family bank. But if you don't have the family bank established, contact us right now to get a free financial profile, and allowing CFG Consulting to build you a strategy that will not only protect your family finances if something happens to you, but also to guarantee your future financial security. But act now. Time is limited. The normal fee just to build a personalized family bank plan is a minimum of $1,000. But for a limited time, if you download and complete the financial profile, there will be absolutely no charge. Take the necessary steps and grab a hold of your financial security. Taxes, inflation, a rocky stock market, and an unstable economy are not going to wait for your perfect time to create your financial future, and neither should you. Now, as you can see, we've demonstrated that the proper funding of the family bank can not only protect your future financial security, but it can make sure that it can protect the financial security of generations to come. When you fill out the financial profile and send it back to us, we will take that information and we will create a personalized strategy just for you that not only will show you how to get out of debt, how to save more money than you've ever thought possible, how you can provide security of your family through not only the life insurance, but we will also help structure a personal will and a personal family trust for you and your family. But time is limited. The response to this video will be in such great demand that we physically don't have the time to develop a strategy for everybody. So it will be on a first come, first served basis only. Again, a first come, first served basis only. So act now. If you have any questions whatsoever, feel free to contact us. But click on the link below, and for a limited time and a limited opportunity, you will get your personalized financial strategy from CFG Consulting, structured around your family bank.